As I've outlined in previous videos, collateral is one of the most important parts of evaluating a bridge loan. Now, in order to evaluate collateral, you have to analyze the underlying cash flow. The holy grail of cash flow is audited financials, both historical and current. We don't always have audited financial cash flows, but we are able to evaluate the loan based on rent roll data as well as site visits, where we get an idea of the current market conditions as well as what the maintenance and capex requirement on a project might be. Current market conditions matter as they determine what an alternative may be for the existing rent roll and where the tenants would be willing to pay rent. During site visits, we can get our own sense of what brokers are telling us about a particular project. Site visits also help us figure out if there's any deferred maintenance and how the maintenance costs are reflected in the quality of the asset. Our goal is to arrive at a model of net cash flows. We model the expected revenues and expenses associated with the collateral and then add to it our judgment to make those cash flows conservative and with a margin of safety. We generally do not lend against speculative development projects, which we call beauty in the eye of the beholder assets. Evaluating these projects is too difficult because it includes too many variables and we think it's fraught with risk. You have to assume many things about the future in order to be comfortable with a bridge loan on a development project, and the timing of such projects is fairly long. Identifying and analyzing cash flow is all about making confident predictions backed by verified data. That just is not as comfortably done on a development project, at least for us. And therefore, development projects are typically not fit collateral for our bridge loans. A good bridge loan always comes back to collateral. And the central question about the collateral is, will the cash flow be sufficient to service the loan? And will the consistency of the cash flow persist in order to maintain and enhance the value of our collateral?